Welcome to this month's episode of Chopping Wealth. I'm Brian Portnoy, founder and CEO of Shaping Wealth, and Chopping Wealth is one of my favorite features of our Compass content platform, compass.shapingwealth.com. Tons of good stuff for you and your clients. I am thrilled today to welcome my old friend Barry Ritholtz. He has published a really wonderful new book called How Not to Invest. And before we dive in, because I have about 5 pages of questions, Barry, say hi and give us a quick synopsis of who you are.
Sure. I'm Barry Ritholtz. I'm founder, chairman, and chief investment officer of Ritholtz Wealth Management. Last filing we did, we were about $5.6 billion in assets. I've been writing and speaking in public about markets and the economy for, I don't know, 30 years. Launched the blog, The Big Picture on GeoCities in 1998.
GeoCities.
I mean, that's how long I've been around. Launched the Masters in Business podcast on Bloomberg in July 2014. That was about 5 years after my first book, Bailout Nation. The new book, How Not to Invest. I'm like clockwork. I drop a new book every 15 years. So look for the sequel to this one in 2040.
2040. Okay.
The first one was really a slog, so maybe that's why there was such a gap between the two. This one was really a pleasure to write. It was a lot of fun to put together.
Perfect segue, because it was truly a pleasure to read. I read it through a couple times,
Really?
and the way both of my sons are finance or business majors, and this is something that I'll have them read in due course, and it's really a field guide to surviving the markets. And in true Barry form, it is witty, it is irreverent, and it is very smart. Let me start where I've never started with a guest before.
Wait, I just want to emphasize that witty, irreverent, and really smart. That's going to be the pull quote for the paperback.
Okay, there you go. There you go. It's yours to use. So it's not often that I look at, let alone get excited about a book's dedication. But I open it up and I see my two heroes, the Charlies.
The
Charlie
Charlies, the two
Ellis.
Charlies. Yeah.
Yeah, the twin Charlies. Charlie Ellis and Charlie Munger. And, you've written some books, I've written the books. When you dedicate a book, it's something you put a little bit of thought into. It's the very first thing that somebody sees, and it's important. It's part of your legacy as an author and as a communicator. Why Charlie Ellis? Why Charlie Munger?
It's a really long story. I'll give you a really short version of it. I've been fortunate enough to interview Charlie Ellis a few times. I never got to meet Charlie Munger. And I had been turning down various a push from various publishers and various friends and family. Hey, it's been a long time. It's been 10 years. It's time for another book, and I just really wasn't enthusiastic about it because, truth be told, there have been tens of thousands of books telling people how to invest over the past century. None of us are especially great at it. The household names because they're such unicorns. They're such outliers, the Peter Lynch's, the Warren Buffett's. And so I come home from vacation one day and I'm just thumbing through, that dead zone before January 2nd, after Christmas, like I know it. And I just start reading a whole bunch of old research notes and commentary and quarterly calls that I've done for clients over the past 10, 15 years. And like this theme starts to form, which is just debunking a lot of nonsense. And, I'm a big collector of quotes, and I always loved the Charlie Munger quote, which is we are the advantage of Berkshire isn't that we were smarter than everybody else. It's that we were less stupid. And it's such a beautiful Mungerism because it really tells you, hey, stop trying to swing for the fences. Just get some wood on the ball. I remember my Little League coach. Don't you're not Mickey Mantle. Just make contact. And that's what Munger suggested, which is its own inverted thought process. But Charlie Ellis is to I'm going to mix sports metaphors. Charlie Ellis is really the guy who told us that investing is two games in one. It's a winner's game and a loser's game. And he wrote a paper in the 1970s that eventually became a book in the 1990s where he likens investing to tennis. And tennis is two games. If you're part of the 0.001 people in the world who are professional tennis players, you win by scoring points. You hit with power, you hit with accuracy, you put a lot of spin on the ball, you keep it away from your opponent, you serve aces, you control the game. That's not how the rest of us play. The 99.99% of people who are amateurs, we play a loser's game. We don't win by scoring points. We lose by hitting the ball beyond our capability. We double fault on a serve. We hit it long. We hit it wide. We hit it into the net. We hit it right to our opponent's sweet spot. And if we only try to stay within ourselves, just return the ball, make fewer unforced errors, you would do so much better. And as it turns out, the exact same thing is true in investing.
Consistently less stupid, less wrong is the key. And
Fewer
so,
errors.
yeah, fewer errors. And that inversion, and was it Munger who said invert, always invert?
Well, he was channeling a 15th century mathematician, Jacobi, who, when confronted with a problem that seems unsolvable, solve for the opposite. And very often that inversion leads you to a solution.
Right.
But I think Munger is the person who brought that to a modern audience.
Consistently less stupid. So what's kind of brilliant about this book is you point out about 279 ways in which we can be stupid. And in Barry format, you say, don't do that. Don't do that. And as you were, before we started recording, mentioning somehow there wasn't a book called How Not to Invest. But in a sense, I read this as a way for you to give wisdom and guidance after 30 plus years of doing this to people as to how to avoid the mistakes. Is that the mission here?
I mean, yeah, to a large degree. Every mistake in the book I've made, I detailed some of my worst, most expensive money losing or gain avoiding mistakes that I've made. I throw lots of people up as examples.
Yeah.
Some really brilliant investors have done some really silly things. And that unfortunately influences us. Look, humans are social creatures. I say in the book, we have neither fangs nor armor nor claws. We're
Mm.
soft, chewy, and delicious. So we have to learn how to be cooperative creatures in order to adapt and survive. And that cooperation is so hardwired into us, it often leads us to be a little gullible and a little naive. A troop of chimpanzees in the trees with watch monkeys on watch, chattering and warning that a leopard's coming. That sort of wetware is in us. And it leads us to say, that expensive annuity certainly seems like a good deal. This guy seems to know what he's talking about. That cooperative background leads us to be a little too gullible for our own financial well-being. And so I don't want people to become cynical and negative. I want them to trust but verify, and I want them to be, a little more skeptical when a deal looks too good to be true. Stop and say, why is this so good? And very often it turns out not to be.
So you are transparent and honest in the book about some of your mistakes. You wanna flag one because
I
there
mean,
you made so many. Let's talk
right.
about but one that really has as you think about your career, one that really sticks with you. And was it an error of commission or an error of omission?
I got one of each.
Okay, give me one of
And by
each.
the way, I thought, when I was writing for the Washington Post, I would do my annual mea culpas every year and say, this is what I got wrong. I don't think you could call out other people unless you're honest about your own screw ups. So probably the omission and the commission. Um, the commission was when I worked at a firm that had about 800 brokers. As their market strategist, I would occasionally make specific stock. I would float specific stock ideas. If enough guys bought it, it kind of there was a big bonus in at the end of the um, rainbow for me. And I've been an Apple Mac head since the late 80s. I had a Mac Classic when I was in grad school.
Mm.
And so having been writing in public, I kind of got to know people like Guy Kawasaki and other folks at Apple. And so when this newfangled iPod came out, and I want to say iPod, not iPhone,
Right.
I got invited to the demo. Long story short, again, Sony Walkman, the little portable cassette players, 1,000 songs in your pocket on this little digital device, right? Think about people used to walk around carrying tapes or CDs. It was insane. Now your phone has a million songs, but plus streaming, but 1,000 songs in your pocket at the time. Apple was $15 a share with $13 cash on the books. This is 02, 03, something like that. And it seemed like, wait, I'm risking $2 on what looks like a revolutionary product, and Steve Jobs has just returned. Let's do that. And so I write up a description about the new product and float the idea, and the brokers all start buying the stock at $15. And I'm watching the reports come in every day. Millions of shares were accumulating, and I'm thinking this is going to be a double, a triple, a 10 bagger. And then at $20, I start seeing, the sales come in. And this was the tail end of the bear market. And I remember grabbing a broker and he's asking him about it. Hey, man, up 33%, got to ring the bell. Everything else sucks. So brokers and that was kind of like, oh, I'm on the wrong side of the street. I'm on the buy side. I should be on the sell side. Hold that for a moment. And I'm like, I'm going to hold on to the stock. And I just kept moving my stop loss off. I had some of my personal account and it crossed 45. It's a triple. Eventually it moved back down and I got stopped out. And I'm like, showed you guys triple. You guys made 33%. I made 300%. When are you going to start listening to me? And of course, the stock proceeds to run up another 10,000%. So that was my thinking like a trader when I had become an investor. That was my sin of commission. My sin of omission was sitting with Howard Lindsay in San Francisco on the seaport with the Oakland Bridge in the background. Yep. And he's pitching me this stupid app that allows millennials to trade for free.
Tiny little brokerage.
Yeah.
Silly, right?
Just what a dumb. I literally said to him, Howard, that is the dumbest idea I've ever heard in my life. Now, to be fair to me, we had moved to the fiduciary side. We had moved away from, this was 2014. We had just launched the firm a year earlier. We weren't doing transactional business. It was all fee-based. It was broad, diversified indexes, not stock picking, not any of that crap. But it turned out that Howard was pitching a seed round of Robinhood, and a few $1,000s would have been worth tens of millions of dollars 10 years later. And again, to be fair, it was very off-brand. The pandemic pretty much put Robinhood on the map, but for that, which was kind of unforeseeable in 2014. But hey, how often you leave $100 million on the sideline? It was a giant win for Howard. And the lesson is, if you're going to dabble in alts, well, defer to the people who have a good track record and are in the top, I don't know, quartile, decile of that, and don't venture too far afield because you have no expertise in it. There's a chapter in the book about epistemic trespass. That was a perfect example of, hey, I've had a pretty good track record, timing markets and picking broad sectors. What on earth made me think I could do seed investing? Nothing.
So I want to plant a flag on a very foundational definition. What does it mean for an investor to succeed? Is it beating the market? Is it making more? Is it turning $1,000 into 10 million based on the kind of story that you just told? When not just the financial advisors who are our core audience, but other folks, friends and neighbors listen to this. and they're thinking about, well, what am I really trying to get done here? How would you define success for them, such that you are teaching them how not to, get in their own way?
Sure. Success starts with two fundamental building blocks. What is money and its purpose? And what are your goals in life? Right. I mean, these sound so basic as to be a given. People don't know what money is. I'm genuinely shocked how often I have a conversation with people. No, it's not a way of keeping score. No, it's not a store of value. Money is a medium of exchange that allows you to deploy it in order to serve a variety of purposes. I pay my bills with money. I pay my taxes with money. I specifically use it to invest. I focus all my basic security is covered with money, Maslow's hierarchy of needs.
Hmm.
You go beyond that, your entertainment, your ability to spend time and build memories with friends and family. To me, that's what the value of money is. I can exchange my time, energy, and expertise for money, and then I use money. I can exchange money for these other things I want. Some people get that, but they don't make the next step, which is, what are your goals? What are your financial goals? Sometimes it's you open a 529 and you're saving for a kid's college, a 401k or an IRA, and you're saving for retirement, generational wealth transfer, philanthropy. Money only has value when it has a purpose. And anytime we see somebody engaging in more money for its own sake, look at Archegos. And somebody had just, the purpose wasn't to do anything other than just rack up more and more. As it turns out, that's not the path to life satisfaction or happiness. And it's not the path to success as an investor, because you want to marry the appropriate level of risk to your financial goal. We see this with endowments and with really wealthy people sometimes, that they're just taking on so much more risk. And in a market like 2025, so much volatility, so much up and down. It's like, you have $100 million, you've already won. Why is half your portfolio the highest beta, wildest moving tech stocks in the world? Tesla was down 45% in 3 months. Why are you loaded up with Tesla? Why are you loaded up with Nvidia, the first company to lose $1 trillion in market cap? So I sometimes have to say to people, you've already won. What are you doing? And so having a goal allows you to marry the appropriate level of risk so that you're not dealing with this sort of mayhem. You could go out and live your life and not feel like you're tied to the futures each night. I started on a trading desk. I very vividly remember running around trying to get futures quotes on Sunday night in the late 90s because I couldn't afford a Bloomberg terminal back then. And so, but the people I knew who had one, it's like they would get a phone call from me at 6:01. So, what do we look like for tomorrow? If you're on a trading desk, well, of course. But if you're in your 50s, 60s, 70s, you're retired, you got family, you're touring the world, if you're tied, I had someone say to me, I feel like I'm a slave to the market. Well, then you have too much equity exposure for that politically incorrect observation. You're good. You're paid for. Your kids' houses and your grandkids' colleges are paid for. Why do you need this? You've already obtained all your what you wanted. So I think I've answered the question and kind of wandered into a field adjacent to it. But the bottom line is, money is a tool. You use it to satisfy certain needs. And it should, when you have a goal, you can marry it to the appropriate portfolio and risk.
Well, you were wading into my home turf of behavioral finance, and we're going to kind of circle that terrain as we go on. But as we've all said many times over the years, simple is not easy. So it's one thing to say, hey, have a goal and work toward it, but we know that there's a lot more going on. And not to be cynical or conspiratorial in any way, the system isn't really set up to help us smoothly and easily and affordably get to that place. The financial services industry and the financial media complex might get in our way, which is where I kind of wanted to turn next. Throughout the book and in a couple relatively sharp moments, you had some lacerating comments about the financial media ecosystem and what it does to the regular investor who's trying to make sense of it all. I mean, you've been part of this world for decades. You have been on the networks. You've written for all of the publications, and I think it's fair to say that there are some real charlatans out there.
Right.
So
I love the Bill Bernstein quote. We use the word guru because nobody can spell charlatan.
he's he's good. He's good. So I wanted to get your assessment of the financial media landscape. And more broadly, the information landscape that we live in right now is beyond overwhelming. When you think about all of the sources through social media and YouTube becoming the global TV network and more and more and more, what's your assessment of what folks are dealing with, and what's your advice for transcending the noise?
When I was in grad school, there was literally Wall Street Week with Louis Rukeyser,
I
who would
love that
come
show.
on Friday night. He would chat for 10, 15 minutes to the audience. Then he would bring out his panel, and then he would bring out a guest. That was financial television. 1 hour, once a week, go about your lives. And when you look at how it evolved, first with a single financial channel, the Financial News Network, and
Hmm.
then multiple channels, Fox Business and CNBC and Bloomberg, and at one point in time there was CNN, FN. Um, I tell I use the metaphor in the book about a gardening channel where they plant a tree and it's just like a cam. Remember the old days of webcams where, you're just watching the wilderness or you're watching a. So private equity buys this garden channel and they want to get ratings so they can gussy this up and flip it. And so they bring in panels of people to argue about the tree that's planted in the middle of the yard. And is this the right tree for this climate? Is this the wrong tree? Do we plant it too deep? Are we watering it enough? Is it not getting enough water? How do you feel about pesticides? Should we be GMO free? They're constantly arguing. Nothing they say has any effect on the tree. Just quietly keeps growing. And it feels like that's social media. So we go from 1 hour a week to 5 channels to now social media and millions of people wholly unqualified giving people advice. And so you have to stop and ask yourself, why am I watching all of this noise? What does this do for me? If I'm focused on growing my portfolio for the next 5, 10, 20, 30 years, who cares what happens on a random Tuesday? It's not relevant. And so part of the book asks the question, what are they selling? Always ask yourself, what are they selling? I used to do a presentation hour to ask the audience, what does radio sell? What does TV sell? And the audience invariably would say, advertising. And I had to correct them gently. No, advertisers are the buyers, right? What they're selling is you. They're selling your time, they're selling your attention. And today,
Hmm.
thanks to Facebook and cookies and a whole lot of other technology, they cross reference your time and attention with your browsing history, your credit score, your purchasing history. And so you are the audience. And when you figure that out, you realize I probably am not deriving value from 90% of this. I referenced Sturgeon's Law, science fiction writer in the 50s, got tired of people slagging sci fi. Hey, how come so much of sci fi is not good? And Sturgeon said 90% of everything is crap. And that turns out to have held up really well over the past 75 years. Most mutual funds aren't good. Most ETFs aren't good. Most alts aren't good. Hey, if you get into the top decile of quant funds, knock yourself out. Most stocks aren't good. The data on what drives markets are a tiny handful of stocks. So if all that stuff is bad, people going on TV, selling a product, selling a fund, selling this, selling that, I think you have to recognize that this is a giant distraction. If you're 40 and you're putting money away for the next 25, 30 years, what does it matter what this analyst's opinion about this stock or this economist's expectation of a recession in 2026? How does that affect your needs come 2075? It's just so irrelevant.
Yeah, so I think the questions you're asking are helpful. I mean, those are the pathways because it's easy to say, well, 90% of it's crap, but you're in the mix. You're on social media. You're on one of a dozen different, streams. And how do you know what's the 10% versus the 90%? So the questions are the map. The questions allow you to transcend. um, Part of the problem is it requires someone to take a moment to think about, well, what's being served up to me. And as the advanced form of animal as we are, as you alluded to earlier, that's that's easier said than done.
So are you asking how to get to the 10% that's not crap?
Well,
Because
sure. I mean,
so the short answer is it takes a little bit of work. You need to put together your own all-star team of media people. And mine is probably 30, 40, 50 people long, but they all have something in common. They've all been thoughtful observers of what's going on in the market and the economy through a through a few cycles.
mm,
They've been more right than wrong. No one's going to be perfect, but they've been a lot more right than wrong. There's a thoughtful process behind their analysis, and they're not just dart throwers who got lucky once. They're pretty consistent. And your all-star team might be different than my all-star team, but go down the list of people who, Sam Rowe and Jason Zweig and Morgan Housel and Rebecca Patterson and Jonathan Miller and Claudia Sam and on it goes. The various people who, oh, these people have been consistently value add,
mhm.
and they never run around with their hair on fire. When they get concerned about the economy of the market, it's worth paying attention to. And most of the time, this too shall pass. And you very often need people, at least for me, I want someone who's going to be a calming influence, not someone who's just playing to the algorithm and manufacturing outrage so they can get more clicks and more eyeballs.
The industry sells complexity. I mean, you think about the financial supermarket. I mean, I started my career a little bit after yours. I started as a junior mutual fund analyst in 2000. I was hired by Christine Benz 25 years ago.
That's great.
And the ETF was just coming. There was less than 1,000 ETFs, a bunch of mutual funds, but not as many as there are now. And so the financial supermarket's been expanding for a long time. And, your average investor really isn't in a position to make sense of, this particular fund's stock versus bond ratio or the Sharpe ratio on this other investment or anything like that. And that's just the basics. Things get very complex very quickly. And, many investors don't think of financial services as a manufacturing business, but the industry manufactures lots and lots of products, and complexity often is quite appealing. Comment, if you can, on whether or not there is a premium for buying into complexity, to solving hard puzzles, so that you can find that opportunity that others can't, or the thing that unlocks the opportunity to grow $100 into $10,000.
Sure. So first, our mutual friend Dave Nottig said investing is a problem that's been solved, and that very much is true.
Mm-hmm.
It's not just finance. If you really want to better understand the complexity problem in finance, notice that every profession in the world has their own nomenclature, their own jargon and language. And that has always been done to keep the public at arm's length. After all, you don't speak this language, you don't understand it. Of course, you have to hire us and pay a premium to solve this problem for you. It could be something as sophisticated as investing on behalf of a foundation or endowment, or uncorking a stuffed drain. There's always this jargon. There's think about it. Think of any profession you know. It could be tax accountants, doctors,
Yeah.
contractors. We all have the jargon of our industry, and that's never been a coincidence. Complexity is a feature, not a bug. Hey, don't worry about it. This is complicated, but we have a solution. Pay us money. If the solution is as simple as own a broadly diversified portfolio of low cost indices, rebalance every 3 or 4 years, see you tomorrow, that makes for a terrible television show.
It also makes for terrible conversations on my sidewalk outside of my house because I'll see friends and neighbors when it's warm here in Chicago, and they know I'm not an investment tips guy, but they also know I'm in the market, whatever that might mean to them. And hey, how should I proceed? I'm like, well, buy an appropriate index fund, calibrate your equity risk to your risk tolerance and time horizon, and don't think about it for more than 5 minutes over each calendar year. And they look deflated. They want to think that there is a secret sauce or a passcode to the good stuff that people like you or me might have access to. They want the good story.
To be fair, at one point in history, it was true. There were trusts and cabals and insiders who traded tips, and as often as not, they knew stuff. They knew what was going on. The specialists down on the post on the New York Stock Exchange certainly knew whether or not the company was going to hit or miss earnings, because you couldn't screw your specialist who was trading your stock. So they either had to get out of the way or accumulate shares if the stock was going to run. Like we forget, and before the days of Reg FD, before the days of fair disclosure, companies regularly traded on, I mean, you could call it inside information. Let's be polite and call it non-public information. So at one point in history, that was really true. The problem is everybody thought that they had access to it. For the average person, by the time they got the tip, the person who knew what was going on was a seller. It's already, they were way too late. So that's number one. And number two, the solution around that, at least for me, I started on a trading desk. I always had an arm out looking for a vein. That dopamine hit was amazing. I'm fortunate that I had a little bit of self-awareness to say, hey, you're enjoying this too much and you're not trading for your profit and loss. So the idea behind the cowboy account is now you want to take 3, 4, 5% of your net worth. If this is something, if you have that itch, hey, now you got something to talk about at cocktail parties and barbecues in the neighborhood. But as I write in the book, that should scratch the itch enough so that your big dumb lizard brain, or I wrote, my big dumb lizard brain leaves my real money unmolested. And the purpose of the cowboy account at Ritholtz Wealth Management, the purpose of our tactical portfolio isn't to generate alpha, it's to generate behavioral alpha, so that people say, oh, they did something. All right, I don't have to worry. Those guys are on top of it. It doesn't matter what you did, but you did something so that that action bias is resolved. And if it just keeps up with the market, we're thrilled to death.
Don't just do something, stand there.
Sit there, right? Exactly.
And the cowboy account, putting away a couple 3% of your portfolio just to have fun with, to make it gambling, to make it fun. That's a really wonderful behavioral sort of outlet, as long as there's discipline either with the investor or their advisor to say, well, it's now when it was 3%, now it's zero. you don't get more. Otherwise, it doesn't become a cowboy account. It becomes sort of the beginning of the end of a healthy portfolio.
The advisor's role is to say, wait, you had 4% and it went to zero. Thank goodness, you idiot, you didn't take the 96% that wasn't in your cowboy account and take that down to zero. You obviously suck at this, right? That 3%, that's a lesson. Fuck you and the rest of your portfolio. If you think I'm going to let you touch that, fire me. And then the next time I see you, I'll put a nickel in your cup when you're panhandling on the street. But you said you wanted 3%. You clearly have no idea what the hell you're doing. You're done. You want to touch the rest of that money? Fire me, because I'm not going to be involved in you making yourself and your family broke. How much of zero is confusing to you? And I'm stating it as harshly as I possibly can for effect, but that's the reality. Hey, if your cowboy account does great, like we see a lot of people, how many people today still own Google and Apple and Amazon from 20 years ago? Like the story I told with my Apple stock, the stock runs 50, 100, 500%. Oh my God, how much further is this going? I got to ring the bell, and then it goes another 5,000%. So if it's all of your money, the vast majority of people will not be able to stay invested long in that NVIDIA, right? Because think about how whoever owns NVIDIA today, they bought it from someone who sold it earlier, right? Or pick your poison, Amazon, Apple, Tesla, whatever. Most people can hold on to these stocks for a very long time. So when they have the flip side of going to zero is when the stock runs higher, and you could let it run. If it's 3%, who cares? Let it run, have a good time. But when it's your whole portfolio, I can't tell you how often we've had conversations with people. Hey, my portfolio's worth fill in the blank, 10, 15, 20%, $20 million, 90% of which is Apple or NVIDIA or something. And they don't know what to do. They're paralyzed. So having a cowboy account scratches that itch. If it goes to zero, it's the cheapest tuition you're ever going to pay. Hey, you said you knew what you were doing. I allocated 3% to this. You blew it up and took it to zero. If this was your entire net worth, you would be busted and filing for bankruptcy. I can't let you screw around with your real account. The flip side of it is it went so far and you allowed it to run because it wasn't your entire portfolio.
There's a different point in the book that I really appreciated on the different outcomes of amateurs versus pros. And you presented some good data on how through certain market crises, such as, the pandemic in 2020, maybe some of the bad market action in 2022, we're now in a part, the industry's evolved where you've got a lot of people dollar cost averaging, sort of auto invest through their 401k into index funds or things like that. And the pros or the experts, they're trying to wheel and deal and slalom through complex markets. It was a good piece of evidence for a view that I've had for a while, which is that a lot of the bad rap that investors get is not warranted. Most people, most of the time, are not reacting to the market and bolting out of their portfolio if the S&P falls 5%. Could you say more about this from both sides? Why does it seem that actually there's a pretty large, I don't know if it's a plurality of the investor base or a majority, people actually tend not to lean into these behavioral biases that we know well. And at the same time, the experts have to do something, because if they're not doing something, if they say, hey, we're just going to buy and hold, I'm going to take 1% of your assets every year, but I'm not going to do anything. Call me in 12 months. Tell me about both sides of that equation.
Sure. So the dumb money, as it was called through most of history, actually was dumb money. We've seen an evolution over the past 40 years since St. Jack launched Vanguard in 1974, 50 years ago. And, the world has very much changed. People have learned the benefits of compounding over time. I tell a few stories in the book that people keep fact checking my math, and they're genuinely shocked what happens if you take $1,000 and bury it for a century, or take $1,000 and invest it in a broad market index. But But keep in mind, you as a home viewer, you as a mom and pop investor, you have advantages over the professional, right? You don't have to have a fancy office or a deep research staff. You don't have to run around the world doing presentations, and you don't have to show performance on a annual, quarterly, monthly, weekly, daily, tick by tick basis. Like I know guys who run hedge. Listen, I'm in New York. A lot of my buddies are in the industry. I know plenty of hedge fund managers. I know people who get phone calls on a weekly basis from some of their biggest clients. How'd I do this week? And my advice to them is always to say to them, you did randomly this week, because that's what a week is. Week is random noise. So that's one thing, understanding the advantage you have. But the other thing is that you get to set your goals and manage your risk tolerance and be aware that, here's what this looks like over 1, 5, 10, 20 years historically. And if you have a 10, 20, 30-year time horizon, you have a 95% probability of hitting your targets. You can't say the same is true for professionals who, hey, you're my allocation to emerging market equity, or you're my allocation to non-beta, and they have to play in those waters. And sometimes the wheel turns, and that particular style or geography or factor just isn't working. Nothing works all the time. So imagine you're a momentum trader, and that's your charge to your clients, and momentum has sucked this year, right? Momentum, most years when the market's going up, it works pretty well. It hasn't worked this year. What do you say to those clients? As the home investor, you've done well. Now, the one caveat to all this whole conversation is buy the dip muscle memory has been fixed, and it's 2025, and the entire period following the March '09 lows of the great financial crisis, you've had a giant wind at your back. So what looks like really good behavior, hey, maybe it's a little lucky, because if you would have the same dollar cost averaging and buy the dip mentality from 2000 to 2013, that wasn't a moneymaker until you got to the 2010s. And in fact, the two interesting secular things we've learned, the end of bull markets pull forward a couple of years of the next profits. And so you start the bear market with the previous 10, 15 years showing 20 years worth of gains, and the bear market kind of wipes a lot of that out. But the really crazy thing is that the big money is made by buying during a bear market. It doesn't show up in the P&L yet. You if you were a regular dollar cost average in 2000 straight up to 2013, it looked like you had no idea what the hell you were doing. And then over the next 10 years, that money exploded. Think about what everybody bought if you were a dollar cost average in the early 2000s, when the NASDAQ was 1,100. Stop and think about that. It's 17,000 today. And that's not a million years ago. That's modern
20,
history.
Yeah, it's 20 years ago. Yeah, it's a really interesting point to think about. Even a decade is a moment in time. It's in real time, it feels like forever. But the period from 2012, 2013 till relatively recently, it's been a heck of a ride. And even the bear market in 2020, man, that was almost a flash. I mean,
17 trading days.
Yeah,
That's
yeah,
it.
that was rough. Part of what you're saying attaches to one of my favorite insights that you made in the book, but I think it's most powerfully made by our friend Morgan Housel, is that there's really not much of a connection in investing between effort and outcome. I mean, we think generally in life, hey, if I try harder and if I run faster, I'll win the race. If I study harder, I'll pass the test. But in investing, trying harder, doing more is often kind of not in your best interest. And so that gap, or I think you made a distinction between activity and progress. It's a little bit of a subtle point, but when you turn the light on it to friends and neighbors, they're like, huh, I never thought of it that way. So I appreciate you kind of re-raising that point. It's a
It's
powerful
worse
one.
than that. Here's the crazy thing.
Yeah.
It's worse than that. People spend all this time and effort researching a specific stock, especially in the modern post-Reg FD era. And all the information they're digesting, they're reading research reports, they're reading news stories, they're reading biographies of the C-suite. All that information that's public is more or less already reflected in the stock price. But counterintuitively, it leads people to feel overconfident in their knowledge of the company. And that leads to bad decision making. It turns out that in order to make an intelligent risk reward decision on a specific stock, it takes this much information. Hey, what's the discounted cash flow look like? What's the company's what do we think their potential is for selling their product into the marketplace? That is not a 6-month research project. That's probably 20, 30 minutes of thought. And everything beyond that is just building up your overconfidence. And so you end up with a much worse set of circumstances for the individual.
Yeah, I mean, I spent 12, 13 years of my career doing nothing but interviewing mutual fund and hedge fund managers. They were wrong a lot of the time and didn't really add much value relative to their benchmark, often underperformed their benchmark, but the stories they could tell you about the companies that they were buying and the detail, because these are not stupid people. That portfolio manager, he or she would go into such extensive detail, like, how could they possibly be wrong? Well, guess what? They're wrong probably more than 50% of the time. And
Right.
so I was able to see that, but it's maybe hard to discern. A few more questions, couple more questions as we sort of turn the bend. One is sort of a timely thing. I think one of the most interesting things about the market nowadays and what the game is an extra emphasis on privates, private equity, private credit. I guess we can broaden it to alternatives, but I'm not talking about sort of convertible bond arbitrage and liquid market, that kind of stuff, but really on the on the private side of things. How do you think the game has changed, and do we need any new rules, or do we need to emphasize particular rules from your field book, your field guide, so to speak, to think about the fact that investing in a private equity fund, investing in private credit is almost like a main street thing now, whereas not that long ago, it was completely inaccessible to 99 point something percent of us.
Sure. So we've seen the same sort of thing play out historically, starting with David Swenson of Yale.
Yeah.
When he first began looking at alternatives, it was a white space. There was no competition. There was no one there. He started buying timber. What? Timber. And investing in a handful of venture funds and hedge funds and private equity and private real estate and private credit. And when he did it, those markets were really inefficient. All of this comes back down to, since you're in Chicago, Gene Fama and the efficient market hypothesis. Hey, the irony is the Wilshire 5000 is now down to like 3,459 stocks. We know everything there is to know about every one of those stocks. So the market more or less gets it mostly right most of the time. There are these regular dislocations and reassessments, and hey, we didn't think he was serious about these tariffs. We better lower our future revenue expectations because this is going to be a drag on returns. But most of the time, the market kind of gets it mostly sort of eventually right. When you look in the private markets that aren't $50 trillion, or at least haven't been, there are inefficiencies. And on top of that, there's the illiquidity premium. Wait, you want me to lock up my money for 5 years, for 7 years, for 10 years? That's a long time. Do I really, if I'm going to lock my money up for 7 years, well, then you better give me more than a simple index is going to give me. And so there is an argument to be made that there's 3,500 publicly traded mainstream companies. There's millions of private companies that aren't publicly traded. And there's just an endless fire hose of capital around. So the advantages to being public aren't as stark as they once were. You're a private company, you have access to debt, you have access to credit, you have access to all this expertise. And so there is a credible argument to be made. Hey, if you could get into the top 5, 10, 15% of these companies, they're probably, underline probably, they're probably going to do what they say they're going to do. They're going to provide a return that is hopefully above their comparable benchmark with less volatility and less correlation to public assets. That's really the best argument for this is uncorrelated and helps you as a diversifier uh, to hit your goals. Now, if you're a mom and pop investor saving for retirement, I don't really know what this does for you, but if you're an endowment with a perpetual, if you're Harvard, Yale, and you have a perpetual endowment and you want to subsidize tuition for the medical school for forever, some of these things make some sort of sense. There's a 5% rule where you have to dole out that much of the corpus of your holdings in order to maintain your tax deferred status. So you have future liabilities, and this is a way to diversify. And hey, if the market, think about 2022, the stocks are down double digits, bonds are down double digit. People hate like hell selling something down in order to pay that 5% out. All right, we are getting these dividends, we're getting these payments from our private debt or our private credit. So for those folks, it makes perfect sense. I'm not fully convinced, other than a handful of people. And I used to think it was 10 million and up. Now I'm starting to think it's 20 million and up. Um, all right, a sliver of that makes some sense. But for, the average mom and pop investor with a couple of $1 million and a 401k or an IRA and maybe 529 plans for their kids, it doesn't really solve any particular problems they have.
Last question is asking you to reflect on a quote that from the book that I love. Most of investing is about managing expectations, not maximizing return. And I think that encapsulates just so much wisdom. So maybe, by way of wrapping up, this notion of managing expectations, whether it's you doing the work as an individual investor to really understand what's going on, or your financial advisor setting out and managing those expectations, um, you know, uh, rather than searching for more, maximizing returns. The game that you're trying to teach us is about managing expectations.
Yeah, it goes back to investing as a problem that's been solved. What hasn't been solved is human behavior. So I found it very helpful to use market data to help people contextualize what has happened and what's going to happen. And none of this is market timing. None of this is my great insight. This is just the letting the data speak for itself. So I do a quarterly call for clients, and I want to show you two examples that could easily be misunderstood as market timing, but is not. So we have the 34% pandemic sell-off, market rally 69% for the rest of the year. The following year, 2021, the market's up 29%. I do the January call, and I say something surprisingly similar to what I said in January 2025, when you have back-to-back 25% years. And you go back through history, there aren't a whole lot of back-to-back 25% years. You have to use plus 20% as your frame of reference. And even that is still a tiny data set. And what does history tell us? On average, when you get back-to-back 20+% years, the range is something like minus 10% to plus 12%. The fat part, the average is about plus 5, plus 6%. So the momentum, whatever drove the market higher, that broad underlying economy continues, but you've pulled 5 years worth of gains into 2 years. Don't expect another year like that. So lower your expectations. What I said this year was, hey, if we're plus 5, plus 6%, I'm thrilled. That's not to suggest I remotely expected us to be, down 10%. And nobody really seemed to have a handle on what this tariff policy would look like. The United States has benefited from Pax Americana in the post-war era so much. Who would be so reckless to put that at risk. So I just failure of imagination on my part to think, wait, we're going to put tariffs on how many countries at what price? But so if I got it right, and arguably I did not, um, the idea of saying, hey, we've made so much money in the past 2 years, let's just take it down a notch. People, while nobody likes this, anybody who heard that is like, all right, I kind of we rang the bell. I keep using these expressions I picked up from the brokers in the sell side half of my career. Hey, we did great in 23. We did great in 24. All right. 25 is going to be tough slogging. We did great in 20 despite the pandemic. We did great in 21. All right. 22 was a rough year. Hey, markets go up and down. And if you are unprepared for that, you either have to get your head right or look outside of equities, because maybe this isn't for you. This is what happens. This happens on a regular basis. Never before in history has so much market data been available to anybody at the click of a mouse or a touch of a phone. And so you have to be realistic in understanding what the long arc of history looks like. And if you can get your head around it, you'll recognize over very long periods of times, equities outperform everything. You're investing in human ingenuity and innovation and genius, and you want to participate in that. But that, if it was easy, if it was smooth, if it was carefree, hey, that's the risk-free rate of return of treasuries. Congratulations. It's 3%, 1.5% after inflation these days. That's your alternative.
A perfect place to stop, Barry. This was as amazing as I hoped it would be. I feel like everyone sort of knows where to find you, but they're going to want to buy How Not to Invest. They're going to want to track your podcasts, your blogs, your everything. Tell us where we can, where
Sure. The book you can find, I'm going to hold it up because I love designing the cover. Was a lot of fun. How Not to Invest book.com. You'll find all the audio and hardcover sources both in the US and around the world. Ritholtz.com is where the blog is. All the podcasts show up there. Ritholtz Wealth is the firm. I am not hard to find.
You are not, my friend. Well, thank you for your time. I really appreciate it. And thanks for listening. I'm Brian Portnoy, founder and CEO of Shaping Wealth. This was this month's Chopping Wealth, one of my favorite features of our growing and exciting Compass content platform. So until next time, thank you very much.